Welcome to TalkTickers. You're here because you want the core insights from the latest earnings calls without wading through all the extra stuff.
Exactly.
So today we're jumping right into Waste Connections, their first quarter for 2025.
Yeah, and they really came out strong.
Seemed like it, beating expectations, right? Both on revenue and the bottom line.
Absolutely. Revenue hit, $2.228 billion. That's up 7.5% year over year, which is solid. And that's even with, a bit of a drag from the Canadian dollar.
Okay.
And their adjusted EBITDA, that's a key profit measure, came in at $712.2 million, up 9.5%.
Nice jump.
Yeah, resulting in a pretty healthy 32% margin. Definitely better than they were guiding for.
Okay, so a beat across the board then. Let's dig into how they managed that. What were the main drivers here?
Well, two things really stand out, I'd say. First, pricing. They showed some real muscle in their core solid waste business. And second, M&A acquisitions.
Yeah.
They're still very active there, and that's, a big growth lever for them.
Right. Let's talk about that pricing first. You said pricing power. What kind of numbers are we talking?
So their core pricing actually ticked up sequentially to 6.9%.
6.9%. Wow. Okay.
Yeah. Suggests they've got, real strength in their markets. Customers seem to be absorbing those increases.
And where are they seeing that? Is it everywhere or specific areas?
It seems pretty broad-based, actually.
Yeah.
Good retention across the board. But what's interesting is in the more competitive markets, they actually got higher increases, over 8.5%.
Huh. Even better in competitive spots.
Yeah, definitely ahead of what they'd initially planned for the quarter.
Okay. Now, you also mentioned, or rather, I saw some talk about volume. What was the story there? It looked like it was down a bit.
It was. Overall, volume dipped 2.8%. Now, that's kind of in line with what we've seen recently, but there's context.
Yeah.
About 50 basis points. So half a percentage point of that drop was just due to, some really bad weather back in February.
Ah, okay. Weather impact. So a bit of a one-off factor there if you strip that out.
Right. If you adjust for the weather and also for the ongoing closure of the Chatta Canyon landfill,
Yeah.
they indicated the underlying volume trends actually looked better, showed some improvement from Q4. So the core business seems, pretty resilient underneath it all.
Makes sense. Okay, let's pivot to the acquisitions then. You said that engine is still running hot.
Oh, absolutely. Very active. Year to date, the deals they've closed already represent over $125 million in annualized revenue.
$125 million already.
Yeah.
And we're just finishing Q1.
Exactly. To put that in perspective, that's getting close to what they used to call an average full year of M&A.
Right.
And there was one deal they highlighted, a big state-of-the-art recycling facility in New Jersey.
New Jersey recycling. Interesting. Why that move? What's the strategy?
Well, it's placed strategically. It's meant to complement their growing commercial collection business over in New York City.
Ah, okay.
Yeah.
Synergy there.
Yeah, it's a high-tech plant, gives them a lot of processing power in a really key market. They sound pretty confident about the pipeline, too. They think they'll blow past an average M&A year by, the middle of 2025.
Okay, strong M&A picture. What about beyond the big financial numbers and deals, any other operational stuff worth mentioning?
Yeah, they did make a point about their people, employee engagement, and retention.
How's that looking?
Good, apparently. 10 consecutive quarters now of improvement in keeping staff. Voluntary turnovers down below 12%.
10 quarters straight. That's significant. And that must have flow-on effects, right?
For sure. It means less overtime paid out, less need for pricey third-party help, maybe even less wear and tear on trucks. It all adds up.
Makes sense. A stable workforce is efficient. How about safety?
Also, positive news there. They reported hitting historic lows for safety incidents.
Really? Even with all the M&A activity, integrating new teams.
Yeah, despite all that. And good safety isn't just, the right thing to do. They expect it'll mean lower insurance costs down the road, too. Good point. Okay, let's quickly touch on commodities. Things like cardboard, renewable fuel credits. How did they play out?
So revenues from OCC, that's recycled cardboard, and RINs, the renewable energy credits, they were down quite a bit from last year, about 20%.
Okay, a 20% drop year over year.
Yeah, but they did say things were pretty stable during the first quarter itself. Just for context, OCC averaged around $15 a ton, RINs about $245.
Gotcha.
And their environmental services side, the ENTP waste stuff, relatively flat if you adjust for the acquisitions they've made.
Okay. And the overall financial health?
Yeah.
Debt levels, cash flow, how are they looking there?
Pretty comfortable, it seems. Their leverage debt to EBITDA is sitting at 2.73 times.
That's manageable.
Yeah. And reflecting that stability, Moody's actually upgraded their credit rating to A3.
Oh, okay. A ratings upgrade.
Right. And adjusted free cash flow for Q1 was $332.1 million. That's right on track with what they're aiming for the full year, which is 1.3 to $1.35 billion. Okay, so Q1 cash flow lines up with the annual plan. What about the outlook then? What are they saying for Q2 and the rest of 25?
For Q2, they're projecting revenue between $2.375 billion and $2.4 billion.
Okay.
And they expect the adjusted EBITDA margin to be around 32.7%, so a little step up from Q1.
Right.
Importantly, though, they kept their full year guidance the same. The numbers they gave back in February for revenue, EBITDA, and free cash flow. They're sticking with those for now.
So even with the strong Q1, no raise to the full year yet.
Not yet. They mentioned, ongoing economic uncertainty. So they're holding steady for now, but they did say they'll review it again and maybe update things when they report Q2 results.
Okay, cautious optimism perhaps.
Yeah.
Did they address any other specific macroeconomic worries or potential headwinds on the call?
Yeah, they touched on a few things. Tariffs, for example. They said basically no real impact so far.
Yeah.
Not on growth, not on costs. And for the rest of this year, they don't see much exposure to potential chassis tariffs. And they're already kind of shifting some parts sourcing to U.S. suppliers anyway.
Proactive there. What about RNG, renewable natural gas?
No big shifts reported there either. Demand, pricing, competition all seem pretty stable from their perspective. Their own new RNG plants are still slated for late 2026.
Okay. And inflation, always a hot topic.
Right. They estimate their own cost inflation is running maybe 4% to 4.5%.
Okay.
But remember that core pricing increase we talked about, that's at 6%.
Ah, so a positive spread there.
Exactly. Gives them a bit of a cushion. They seem to think their pricing strategy can handle potential bumps in inflation going forward.
And any parts of the business they see as more sensitive to an economic slowdown?
Yeah, they pointed to two areas, the roll-off collection business and also the construction and demolition C&D waste that goes into their landfills.
Makes sense, construction related.
Right. Together, that's about 10% of their revenue.
Mm-hmm.
But they stress they can, flex their operations up or down in those areas pretty quickly if activity changes.
Got it. What about any news on special waste trends and also an update on the Cheetah Canyon landfill situation?
Sure. Special waste volumes were actually up in Q1, but they cautioned that sector can be, lumpy, unpredictable.
Right.
Leading indicators there, and for C&D too, are things like interest rates, government project approvals, stuff like that. They said their backlog of special waste jobs is strong, but they are seeing some delays in projects actually getting started. Seems like some government uncertainty is holding things up a bit.
Okay. And Cheetah Canyon?
The cost estimate for managing that reaction this year, 2025, is still in that $100 million to $150 million range. No change there.
And the situation itself?
They say it's contained, it's stable. Odor complaints are way down from the peak levels. Production levels are lower too, so stuff that's being managed.
Okay. Any movement on the regulatory side? EPA, anything like that?
They haven't seen any major rollback of EPA rules affecting them. The big thing everyone's watching is PFAS, those forever chemicals.
Right.
The EPA is still expected to clarify its stance. Waste Connections said they've been actively testing, working on technologies for PFAS management. They feel pretty well prepared, actually. They even suggested it could end up being a competitive advantage for them, given their size and resources compared to smaller players.
Interesting take. Okay, one last thing. The Arrowhead landfill they bought last year. Any update on how that's performing?
Yeah, big ramp up there. Arrowhead was acquired back in August 23. Daily intake was around 2,700 tons per day initially.
And now?
Now they're seeing peak days hitting 7,500, even 8,000 tons per day.
Wow, quite an increase.
Huge increase. They expect to handle about 2 million tons total at that site this year, and they see more growth in 26 and beyond. They also explicitly said they're eager to bring in more third-party volume there.
Got it. Okay, that's a really thorough look under the hood at Waste Connections Quarter. Thanks for walking us through all that.
No problem.
Now that brings us to our favorite segment. This is not financial advice. Based on everything we've just discussed, what's an outrageous but plausible trade idea you've got for us today?
All right, here's one for you to chew on. You look at Waste Connections, strong pricing power, right? Consistent cash flow. They seem proactive on potential regulatory stuff like PFAS.
Okay.
So the idea is go long Waste Connections, buy WCN stock, but pair it Simultaneously, you short a basket of smaller, maybe privately held waste companies.
Short smaller competitors. Why that specific pairing?
Well, you'd focus the short side on companies operating mainly in regions where you expect environmental rules, maybe around PFAS or landfill emissions, to get stricter faster.
Ah, okay. Betting on regulatory divergence.
Exactly. The thinking is WCN has the scale, the money, the tech to handle new regulations, maybe even benefit as smaller guys struggle with compliance costs.
So WCN gains share while the smaller ones get squeezed.
That's the potential scenario, yeah. The short position helps hedge against, a general downturn hitting the whole waste sector. It's a relative value play. Essentially, betting WCN outperforms these specific smaller players because of the regulatory environment.
Definitely fits the outrageous but plausible bill. A bet on scale winning out in a tightening regulatory world. Interesting.
It's odd.
All right, that wraps up our deep dive into the Waste Connections earnings call. We've hit the key financials, management's view on performance drivers, and their outlook. As always, remember, this is purely informational. It's definitely not financial advice.
Please do your own homework before making any investment decisions.
Absolutely. We'd love to hear what you think, though. What are your thoughts on Waste Connections' path forward or the waste industry in general? Feel free to join the conversation. Thanks for tuning in to TalkTickers.